A home equity reverse mortgage, or what we call a HECM, is a Federal Housing Authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are age 62 years or older, and it has some unique features that make it a valuable tool in retirement planning and aging in place. This video will discuss set-asides and reserves that can arise and be taken out of a HECM upon origination. HECMs have both reserves and set-asides. Reserves are exclusions from available credit put away to pay for future interest and mortgage insurance, assuming that the borrower drew all the money immediately, made no payments, and therefore had to pay for the cumulative accrued interest and insurance out of the sale of the home. If the available credit is unused in a particular month or year, the reserve previously assumed to be needed on that drawdown for that month or year is released from the reserve and added to the available credit. In this way, unused credit on the line of credit of a HECM actually grows monthly and annually. What many people do not appreciate is that the reserve is calculated net of anticipated appreciation in the home over the remaining life of the youngest borrower. The appreciation rate is generally in the 1 to 2% annual rate. But remarkably, the product actually gives you credit for the future anticipated appreciation. The gross loan amount is generally the appraised value of the home less these interest and mortgage insurance reserves. Set-asides, however, are money taken out of the gross loan that's already been calculated, out of which the reserve has been eliminated. Set-asides are for specific purposes. A repair set-aside is established to hold back an amount to pay for repairs identified during the appraisal process. It's short-term in nature. Anything unused is returned to you. A life expectancy set-aside, or what we call a LESA, is exactly that. If the borrower has insufficient income to meet their property charges, either a full or a partial LESA is established to make sure that the charges get paid over the estimated remaining life of the borrower. Generally, a borrower that has poor credit or insufficient income will not qualify for a HECM unless we set up a LESA. If your home needs major repairs, estimated above 15% of the appraised value, the lender may require that those repairs be completed before it will give approval on the HECM. However, below this level, the lender will set aside a necessary repair estimate and will administer the contractors who are completing the repairs until they are finished. The lender will always increase any contractor or appraiser's estimate for repairs to make certain that they have sufficient money set aside. You will get back any unused portion. On a home being purchased, regardless of the size of the repairs, the lender will require that all repairs be completed by the seller before it approves the HECM. If you have bad credit or insufficient income, it is still possible to get a HECM. But your bad credit would have to be isolated and due to unusual circumstances or events outside of your control. And the lender may require the life expectancy set aside that either fully or partially puts aside money to pay for future property taxes and insurance over the expected life of the youngest borrower. And some people actually set up a voluntary life expectancy set aside so that they know they have set aside enough money to pay their property taxes and insurance and remain in their homes without worrying. So what is a LESA? Let's take an example. Say you have $6,000 annual tax and insurance, homeowner association dues, land lease obligations, and the rest, and that you're 75 years old. We would add 20% or an extra $1,200 for inflation. We've estimated your remaining life at 12 more years, and we calculate that that's $7,200 paid annually for 12 years, assuming our mortgage rate and our rate of mortgage insurance premium. We would calculate that we need to set up a LESA now for $52,200. Note that it's not $7,200 times 12, because you don't need the money immediately, so its present value is less than the total amount. Now, the lesser funds are not available to the borrower, and the requirement can only be changed if it was voluntarily set up. If the lesser had to be set up because of an underwriting requirement, then the only person who can change the requirement will be the lender, or if you pay off the loan. The lender will now pay your home property charges out of this set-aside, on your behalf, of course. The thing you have to remember, though, is if the lessor runs out of funds, the borrower is still liable for the property charges. So if your property charges keep increasing beyond the original estimate made by the lender, or you live longer than what the lender estimated, the lessor will run out of funds. And if so, the borrower is liable, not the lender. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers. Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.